Hey guys, hope all's well today. Let's kick it off right away with this workshop on two times leveraged single stock ETFs, which have been a new addition to the market the last couple of years. And they're pretty interesting overall. There are a lot of benefits. We'll dive right into the pros and cons, how they work, and all that stuff. If you have any questions at all, please save them for the very end and drop them below as well. So we're gonna cover off the mechanic, which is how daily reset of 2x exposure is built and why it isn't two times the stock over time. This is a key misconception that a lot of people don't understand that over time, essentially, you're going to lose value on these leverage ETFs due to volatility decay, which is the second point over here. We'll discuss fee structures, pros and cons of using these, the tactical trade using NVDU, which is NVIDIA's 2x leverage ETF, or MSFU, which is Microsoft's leverage ETF after a sell-off, and looking at ETFs versus using options as well. Okay. So what is a 2x leverage single stock ETF? Well, it's essentially a product that's designed to deliver two times the daily percentage return of a given stock. Could be Microsoft, Meta, etc. There are many stocks that have this available now to them. But remember, this is not two times its return over a week, a month, or a year. The exposure is achieved primarily through total return swaps and options on the underlying stock, not by simply borrowing to buy two times the shares. So very, very important to understand how these are structured. And also remember that these funds are reset every single day at the end of the day, right? So they're reset daily, and as a result, over time, you're going to see pretty much a drift lower, typically, unless we get a move up, up and to the right on their actual chart, which happens on occasion. But again, on long time horizons, look at most of these charts, they're down and to the right overall, right? And this daily reset is the single most important mechanical fact in this entire presentation to understand. Everything else follows from it, right? So the daily objective is two times the stock return today, not two times the stock return since purchase. So important to note here, holding it for more than a day or two or a week or two, and the compounding of daily resets, not just the direction, starts to drive your returns overall, right? So typically these aren't meant to be held longer term. They can be used, mid-term perhaps. But again, it's important to understand that the drift lower typically provides a con to long-term holders of these assets. Very important to understand that. Um, Now we have the Mag 7 leverage suite. So the Mag 7 names all have two times leverage ETFs built for them. NVIDIA has NVDU, Microsoft has MSFU, Apple has AAPU. If you kind of note here that most of the names are the first three letters of each ticker symbol, followed by U at the end, replacing the last letter, except for with Google and Tesla, in which case it's GGLL and TSLL. And these are issued by Direction. Um, so there are also companies that offer these as well. There's like Granite Shares, for example. There's a few more companies, but typically you want to look for Direction and also look at the fee structure of these assets too, because they do charge higher fees. They're an actively managed asset, right? So this is also why longer term you will see lower returns if you hold these longer term. They're meant to be traded, not to be held as investments, right? Again, these are swap-based, actively managed funds, not simple 2x margin baskets. Liquidity and swap counterparty terms differ ticker by ticker. So read the prospectuses of each asset before you trade it. Yeah. Next thing is why the daily changes everything overall, right? A stock that round trips back to even can still leave the 2x ETF underwater. So for example, let's say we have a stock, doesn't matter what stock it is. We're at $100 on the first day. Day one, it goes up 10%. What happens to the 2x leverage ETF? That goes up 20%. So great if you're holding it, right? But on day two, let's say that it goes back down 10%. What happens to the stock? It goes down to $99 per share, right? So it's down 1% net, despite having not moved at all whatsoever. Whereas the 2x leverage ETF is now down $4 because of the effect that this leverage has. But notice that it's down 4%. So you're down pretty much 4 times what you'd be down holding the stock itself, right? So both days net to a 0% 2-day move on the stock. The 2x ETF, however, applies the multiplier to each day's starting balance independently. So the down day erases more dollars than the up day created. And that gap is leverage decay, and it compounds with every additional day of volatility, right? So this is a key risk here, right? A flat or choppy stock can still produce a losing 2x ETF position. Direction alone doesn't determine the outcome. This is why these products are built for short directional windows, not for set it and forget it holding, right? Obviously, if you have a long-term bias to a stock, where it's heavily beat up, it's not a terrible thing to use in conjunction with an option strategy. Like for example, let's say I know on Micron, which is MUU, you can sell the December 50 strike call options right now for about $5. The current asset price is about $25 overall in MUU. And you can buy the out of the money put, I think it's the 20 strike for about $5. Therefore, if you were to sell the 50 strike call option against your shares and buy the 20 strike put option for the same price, it's a net cost of zero, meaning that you have downside from the current price 25 to 20, and that's it. But you have upside from 25 all the way to 50. Therefore, you have upside of 25 with risk of 5, or said another way, asymmetry of risk of 5 units of reward per unit of risk, essentially, right? So again, combining these with option strategies can be very, very powerful if you know what you're doing. The next thing is volatility decay, right? Decay is a function of volatility, not just direction. So leverage decay, also called volatility drag, is the gap between a leveraged fund's actual compounded return and the naive expectation of the 2x on the underlying's return, essentially, right? So this also applies more the more leverage is produced by the asset itself. So for example, you might have like SOXL, which is a 3x leveraged ETF on semiconductor stocks. That will move a lot more typically than a 2x versus an average stock, for example, right? Because the leverage decay will play out over time. It's why if you look at most of these charts, they're down and to the right. Then what happens? They reset. They do a reverse split. They go back up to a higher price again, and then over time they drag back down. They're meant for trading. They're not meant for holding longer term. So conceptually, decay grows with the square of daily volatility. A stock that moves violently in both directions decays faster than one that grinds steadily, even at the same average return. So you can see over here the different paths, right? If we have a trending path, let's say, for example, up, 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 right? Versus a choppy path where we're down, then up, then down, then up, then down, then up, you're going to have high decay on the chop, whereas you're going to have low decay on the move higher overall, because as we move higher consecutively, the compounding effect works in your favor. But if we chop, it works against you, right? So this is why you got to be very cognizant of when to use these assets, because they are appropriate in certain instances. Like for example, Reddit had earnings a couple of weeks ago. They fell about 22% after earnings on a very, very good report. Their leverage ETF, RDTL, fell from about 18 down to about $10 or so, or 10 or $11, right? That would have been a nice time to get into it because, again, it's already incurred that drawdown post the binary event, especially when it was positive news. So the idea there was that we expected to recover in the short term, perhaps. And so what happened? It went from 11 to almost 16 in the span of about a week. So if you bought it on the decline, you would have made some good money on it, obviously. If you bought it prior to the event, it would have been very hard for you to make back your money overall, because remember that an asset that falls, let's say an asset, for example, falls 25%, meaning that the 2x ETF falls 50%. What has to happen now for you to break even? The asset itself has to double in value, essentially, just for you to break even on your position overall, right? So again, this is why it's important to be buying and using these assets only at the lows, typically, not at the highs. The highs denote a high degree of risk overall. Very important, right? Next thing is volatility decay again, right? So same net move, different outcomes overall. You can see the various different paths overall. We have a stock trending path, which is the green line over here. right? What happens? It goes up, then it goes down. We have the 2x leverage ETF overall here, right? What happens? It goes up and then down, right? We have the stock, which is the orange line over here, which is a choppy path, right? It goes up, down, and then kind of flat. And the ETF itself goes up big, down big, up big, down big, and then flat lines. And notice it's lower than the stock asset each time, essentially, right? So very important to note this as well. Um, the next thing is fee structures, right? What are you actually paying for? Well, these are actively managed funds, so therefore they charge a fee. That's how they make their profit overall as a fund managing these assets. So they have expense ratios between 0.95% and 1.15% roughly. You can see these on the prospectuses. If you go to, for example, like FinViz, type in a ticker symbol, go to the left-hand corner of your screen, at the very, very top, it'll show the fee structure right there as well, right? These are swap finance spreads, right? They're embedded, not itemized, right? So the cost of the total return swaps used to create leverage exposure, priced off of short-term financing rates plus a dealer spread overall, right? So they are incurring a spread as well. So they got to pass it on to the customer naturally, right? There's also a borrowing and overnight cost, and there's obviously bid-ask liquidity costs as well. So this is why they're higher fees baked into these assets as well, right? Next thing is total cost of ownership, right? So you have upfront cost. For the 2x leverage ETF, you have full notional value, no approval needed. This is one of the key benefits of using these assets. Like, let's say you're in a registered account, like a retirement account. In the US, you have your 401ks, you have your Roth IRAs. In Canada, you have your RRSPs for retirement and your tax-free savings accounts as well, right? This is where you can use these assets to perhaps leverage a given thesis without incurring a lot of risk if you're structuring your trades using options perhaps as well as the 2x leverage ETF, right? Because you can't use spreads typically in your you can't use spreads at all whatsoever in your retirement accounts or in your tax-free accounts. So very important to understand this, right? So these are beneficial overall there, right? You have 2x leverage ETFs, full notional value, no approval needed at all whatsoever. Long call options, premium costs only, of course. Reg T margin, 2x the stock. So if you're buying 2x the stock position in your portfolio using margin, right? You're pretty much incurring interest on that margin borrowed, essentially. You're borrowing money to buy double the amount of stock, right? So different options you can use to kind of leverage your position overall, right? They have different pros and different cons, right? Call options expire at a certain expiration date, right? These will decay, the 2x leverage ETFs will decay over time due to volatility drag, right? The margin option that has a drawback in that if, for example, you see the underlying asset decline in value, you can lose your entire position. Kind of like we saw with that situational awareness fund where they were 400 times levered, sorry, 400% levered, right? All that had to happen for them to blow up was a 25% decline in their overall portfolio value, which is what happened essentially, right? So keep this in mind as well, right? Maximum loss of your positions, obviously, for single stock ETFs can approach 100% if it goes to zero over time, right? For the call option, premium paid, which is defined risk. And then for margin, again, it can exceed the initial capital overall, right? Account requirements, as I mentioned, there's zero requirements for 2x single stock ETFs. Options are required, options approval is required to trade call options, and margin account is required to use margin naturally, right? Holding horizon fit. For 2x single stock ETFs, you have days, not months. For call options, you have pretty much whatever your duration is for your thesis. Could be a week, could be a day, could be a month, could be a year, right? Could be 2 years perhaps, right? For margin, this is flexible, but it's also expensive to hold because you're incurring interest every single day that you're holding the position because you're borrowing money to lever yourself overall, right? I do like the idea of using call options, obviously, because you have fixed risk overall. You don't have that volatility drag overall, but you do have time decay to worry about. So there are always going to be drawbacks of using different vehicles depending on what your overall objective is, right? The key is understanding what the drawbacks are and accepting those risks as part of your risk overall in endeavoring to generate returns using different assets. All right. So where these assets generally help, right? No margin or options approval required. Trades in a standard cash account, just like a stock ticker, right? They have defined downside. You can't lose more than your invested capital. unlike an undefined risk short or naked leverage position. So there are also short ETFs as well, which bet on the stock going down too, right? Um, thing about this too is that let's say for example you want to play a binary event like earnings. Let's say for example like tonight, CoreWeave reports earnings after hours. The current spot price of the stock is around $90 per share. You can trade CRWU instead of CRWV, which is about $4 per share, and your risk is much more defined in that if CoreWeave falls, you're going to lose money in CRWU at 2x the rate percentage wise, but a much smaller value of the actual asset versus a $99 asset, for example, in CRWV, the actual stock itself, right? So keep this in mind as well. Simple one-click access, right? A single ticker symbol delivers leverage directional exposure without building an option structure. And then this is also built for tactical windows, well suited to short, high conviction, catalyst-driven trades measured in days, such as earnings events, for example, right? um, where they will hurt you is decay and choppy markets. So if you chop for a period of time, they will hurt you because as we saw in those charts, the chop will just erode the value of the asset over time, right? These are not a buy and hold instrument longer term. They're better to be used in shorter windows overall, multi-week or multi-month holds. These will cause tracking errors to go against you essentially, right? So typically you want to look at a chart and identify a support area. Like for example, Microsoft, prime example, MSFU is trading at $20 per share when MSFT was trading at 350 a share roughly. And just fast forward, literally less than a month later, MSFU is trading at $40 per share, double the value, went up 100%, whereas MSFT went from 350 to $500 per share. So that's where it really benefits you is if you're able to catch a move like that, where you see a name that's undervalued, perhaps like Microsoft, beat earnings and then run from 350 to $500 per share very quickly. The 2x leverage ETFs work heavily in your favor without causing you a dramatic amount of risk overall. Because again, you're risking $20 per share versus 350 per share at the support area, right? Next thing is obviously that the high expense drag will affect you and hurt you as well. So you got to be cognizant of this too, right? Because it will drag over time. And lastly, you have single stock concentration, right? Because you're focused on one asset that is 2x leverage a given asset, like NVDU, for example, is purely NVIDIA. Therefore, it elicits zero diversification. The entire position rides on one company's idiosyncratic risk, right? Um, the post-selloff setup is typically what you want to look for, right? After a sharp sentiment-driven drawdown, the perceived risk of further near-term downside is often lower than it was on the way down, even if the long-term thesis hasn't changed. So last week, for example, we saw SanDisk report earnings. Across the board, they were everything was great. What happened? Stock price was down 10%. SNDU went from about $18 per share down to about $13 per share the morning after earnings. That same day, it went from 13 to almost 17 in that single day, right? So again, capturing the move after a sharp sell-off is a much better setup than doing so prior to a binary event typically, unless you're okay with the risk into the binary event itself, kind of like Microsoft, where it ran heavily to the upside and the position on MSFU went from 20 roughly up to now it's at $39 to $40 per share there, right? Sellers who wanted out have largely sold it typically after a sell-off, right? Force and panic selling tends to cluster near the drawdown, not after it. Also important to note too that if we have bad information, typically like a bad news event against a given company, typically you want to wait 3 days to allow the sellers globally to get out of the stock, right? It's usually a mistake to buy the first day after, unless of course it falls on good news, kind of like with Reddit, for example, where Reddit fell 22% after earnings on a solid report, which a week later following that drop, it fell down to a low of, I think 135 from like 170. It popped back up to 160 within a week or so, right? So that's kind of what you want to look for. Is a good setup is oftentimes positive news elicits a sell-off in the stock to a support area. You buy there, you wait a few days, capture the move to the upside, get out, profit, find the new trade, right? Next thing is volatility, while still elevated, is beginning to compress rather than expand further, right? The last thing is a short defined risk window opens where leveraged long can capture a bounce without needing a multi-week hold, right? This is a tactical trade thesis, not a long-term investment thesis, kind of like Reddit again, right? And so you want to look for a sell-off down, capture the move somewhere over here in a leverage ETF, and when it bounces back up, you get out of it. You don't hold it like a long-term position and say, you know what, I'm gonna hang on to this position because I like the stock. That's not how you trade these assets, right? Right. So very important to understand this as well, right? Whoops, there we go. Here's a worked example with NVDU after a drawdown, right? So the setup was that NVIDIA had fallen or has fallen at the time, about 2 weeks ago or so. It fell about 18% from the high on a broad tech derating, right? So selling volume is fading, implied volatility is beginning to roll over overall, right? Thesis, near-term downside risk is reduced. A short bounce toward prior support is expected path over the next 37 trading days or a couple of weeks perhaps, right? The structure, a defined dollar amount is allocated to NVDU instead of NVIDIA shares to express a leverage view without a margin account, right? Exit discipline would be a hard time stop, days, not weeks, and a price-based stop are set in advance. The position is not intended to be a hold. So as an example with NVDU, when NVDU was at about 190 a share a couple of weeks ago, NVDU was at about $105 per share, right? Fast forward to today, NVIDIA is up at 220 a share roughly, and NVDU is at 140 a share. So NVDU gained almost 40% of value, while NVIDIA, the actual stock itself, gained about 10% of value roughly from that drawdown overall. Or no, it's about 15% roughly, right? So either way, a very, very nice expression of a thesis off of a support area in the case of NVIDIA. And this works much better typically with the mega cap names like Microsoft, Google, NVIDIA. That's why I discuss them pretty often because again, you don't need to go and find exotic names to make good money with. You can make very good money with the Mag 7 names recurringly if you know where the support and resistance areas are on the charts. Three ways to express the same bullish view, right? Simplicity, you have the leverage ETF, right? Capital efficiency low, complexity is low, max loss, full positional value, time decay none. But remember, you have that fee drag and you have that volatility drag as well, right? And you have defined risk, long call option. Capital efficiency is extremely high, the best capital efficiency overall, roughly, aside from a call spread. Complexity, medium. You need to understand how calls work, obviously, and be approved in your margin account or in your retirement account or tax-free account. Your maximum loss, the premium paid, and the drawback here for time decay is that theta erodes value daily, right? So each day you're going to be losing a little bit of value, all else remaining constant. The most capital efficient way is using call spreads because you're offsetting a lot of your time decay typically and your vega exposure, your volatility exposure by using spreads. So these are usually the most efficient ways of expressing a bullish thesis. Again, the drawback here is that you're capping your upside on a given name, but I don't really care about that so much. It's more about base hits recurringly versus trying to hit that home run that might come once in a while. But typically it's elusive and endeavoring to hit a home run, what happens oftentimes? You strike out. Key takeaways here, guys. Daily reset, not cumulative overall. So the 2x objective applies to each trading day, not the life of your holding period. 2, volatility drives decay overall. So the more chop we get, the more range bound we are, the more the assets decay. And this applies especially higher or more pronounced, the more leveraged an asset is. So for example, like a 3x leverage ETF like SOXL or TQQQ, those will decay much, much faster, right? Fees are meaningfully higher, right? Expense ratios plus embedded swap financing costs stack up fast on longer term holds. So they have a drag on returns. These are best suited to short tactical windows, days, not months typically, especially in post-selloff setups where near-term downside looks limited. And then also understanding the alternatives to 2x leverage ETFs is important. Options and call spreads can express the same view. I mean, call options and call spreads can express the same view with different capital efficiency and risk profiles. And last but not least, before we break off, guys, and cover Q&A, remember everything here is discussed is for educational content, not investment advice at all whatsoever. Please do your own research, manage your risk very well, and if you have any questions at all, do not hesitate to ask. Drop them below, and I'll see you guys next week. Okay.